Hi, I'm Jamin Yee, and on behalf of my colleagues at Roland Yee, welcome to another edition of our Money Manager interview series. A foundational part of our investment strategy is due diligence. Our process begins with the 4 P's: performance, process, philosophy, and people. In all the years I've had the opportunity to meet directly with investment firms, I've learned the most important part of money manager research is people. In the end, after all the analysis is conducted, we want to answer this question: do we trust our clients' money with these people? I hope you enjoy getting to know some of the managers we utilize and gain some perspective and insights on their respective strategies. Today we're joined by Cameron Martin, Martin Capital Partners Chief Investment Officer. Cameron is going to discuss the economic environment for the second half of 2022, including inflation and interest rates, as well as Martin Capital Partners' core dividend investment strategy. Cameron discusses the importance of having a long-time horizon, profitability, and the importance of dividend-paying stocks in an inflationary environment. This interview was recorded on August 8, 2022. The views and opinions expressed here are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Roland Yee Investment Advisors and are subject to change without notice. Welcome, Cameron. Thank you for your time today.
Thank you, Jamin. Good to be here.
Tell us about your background and how you got into the investment business.
My father started in the business in 1966 with Harris Upham, so he was a broker. So I saw it around the house, but I really, frankly, wasn't that interested in it. As a kid, I spilled soda pop all over his desk in the early 70s on one of my visits, and then in the 8th grade, I did a report about what he did for work and ended up falling asleep because we had to get up so early. So I didn't think that this line of work was for me, working East Coast hours. Eventually, I studied sociology in school, so wasn't on a path necessarily to business, even though I think sociology is very applicable to our work. But I did kind of after school start reading the journal, got interested. Long story short, ended up working for my father's team, doing due diligence on money managers. That was going to be one of my roles early on. Found out I loved the business from the other side of the table and ended up managing some money by the late 90s within that firm. Also knowing I probably wanted to do something outside of the brokerage firm because I had a passion for running money, particularly in an equity income format. And so eventually led to starting my own firm about a dozen years ago.
Well, congratulations to the success of your firm.
Thank you.
I personally appreciate your newsletter that you write.
Thank you.
In your firm's investment letter in January of last year, you discussed the terms investing gamification and the speculative nature of the markets. Can you expand on that?
Yes, I'd be happy to. So, the bull market started in 2009, the last bull market, and we had tons of monetary and fiscal stimulus at that time. It was a normal bull market for a while, and then the late last decade, it felt like there was more and more speculation that was beginning to happen in the markets. Then, and I think it was the longest bull market ever by the time that COVID came around. And when COVID hit, the realization of that, the markets pulled off massively. It was a very quick bear market and then back to a bull market. And it almost like the trend from 2009 hadn't even been broken, even though officially we had a COVID bear market in between. But when the Fed came in again with massive monetary support, and then we had unprecedented fiscal support, there was so much money in the system. There were people, frankly, working from home, not even working for a while, yet getting payments, in some cases not to do that. retail environment exploded. There were so many more new retail investment accounts at that time, and I think there's a difference between democratization of the markets, which is healthy, and then oftentimes new entrants to markets are inexperienced and they get exploited by certain areas. Picking on Robinhood a bit. So Robinhood came out with an app. It was essentially a social media trading platform like it had never happened before. And so we'd gotten to the point where there was all this money in the system and it became almost a game. The word stonks, stocks don't go down, the meme craze, etc. There was a massive amount of speculation. And there's a lot of ways we could define that, but my favorite stat on this is Goldman Sachs has a non-profitable tech index, which is essentially a bunch of technology companies, and even expanded a bit beyond that to include innovators and disruptors in other areas, other sectors, but that are not profitable. And yet that index in a 10-month span between 2020 and 2021 appreciated 390%. And so there was just massive, frankly, speculation and even gamification of the markets, which we were warning at that point was participants needed to be careful of that.
390%.
Yeah.
So if we shift to your firm's outlook, what do you see with the economy and the market for the rest of this year?
Well, I try to steer clear of prediction. We try to be prepared and for all environments, and we'll get into our strategy, I'm sure, on how we try to do that. But I do think that this market in the next 2 to 4 quarters is digesting a couple of major things. Number one, inflation, like we haven't seen in years. And then therefore the cost of money and the rise in the cost of money that we saw in the early part of this year, now that's retreated a bit. But those two things are of major importance. Obviously, we've got geopolitical hotspots all over the world, and so that's going to impact it as well. But my view is the market is going to be very volatile as it digests. Is the Fed going to be able to tame inflation? And there's going to be times it looks like they are and times it looks like they aren't. And so I think we're going to have a very volatile period of time in the next 2 to 4 quarters. And that's my best prediction, but I don't see a huge run to the upside, and we'll hope that we don't see a huge run to the downside unless inflation looks like the Fed is still way behind the curve, which they may be.
So speaking of the Federal Reserve, in your most recent letter titled Paradigm Shift, you discuss the Fed's policy and what needs to be done going forward. How is the Fed currently managing inflation?
Yeah, that's the $64,000 question. First of all, paradigm shift. Let's kind of talk about what I meant by that. It might have been too big a word. Time will tell. But this first 6 months to this year was the worst 6 months for the S&P 500 in 52 years. Normally, when that happens, you would then see the bond market in kind of a flight to safety hold on to capital. It did anything but. Deutsche Bank did a study building the 10-year Treasury note and a proxy for that prior to when it was first issued, looking all the way back in the history of our country. And it was the worst first 6 months for the bond market since 1787, the year before George Washington was president. So if you take those two major asset classes and look at their reaction to inflation and rising rates, to me, that's the mark that there's a paradigm shift in the way we're going to be viewing inflation and rates compared to the previous 40 years.
So we have this perfect storm. Worst start to the equities in 50 years, you said?
Yeah, 52, yeah.
We have a bond market that goes back a couple hundred years of underperformance for the first 6 months. And then we have more inflation we've seen in a generation. I know you don't like to predict short term, but what are your thoughts of inflation going forward?
Well, if you look at inflation to 1960, there's been 3 20-year very distinct periods. Basically, from 60 to 1980, you had rising interest rates that went violently north in the latter part of that period. Volcker was able to break inflation in the early 80s, and we had declining inflation for basically the next 20 years until about 2000. From that point, we had extremely tame, benign inflation, 2 to 3% for the last 20 years. So it was kind of a very enviable spot, frankly. Now we're seeing the latest print of over 9%, which we have not seen in 40 years. So when you look at the chart and the breakout of inflation, I think it's very unlikely that we're going to retreat to the 2 to 3% we've enjoyed for the last couple decades. Do I think inflation is going to go higher? Probably not. I think we've probably, hopefully, seen peak inflation, but I think it's very likely we're going to experience inflation at a much higher rate, and that's going to change the investing environment because we haven't seen it for so long.
So if we're going to shift to the markets in your investment strategy, how would you explain to our clients what a stock dividend is and how it works?
Mm-hmm. So a dividend in its simplest form is a profit sharing with shareholders, and in our case, minority shareholders in the public markets. So it's a cash payment, generally made quarterly, directly into the client's account. And companies pay out different levels, i.e. yield based on stock price of dividends. And so we think those payments are extremely important for many reasons. The predominant reason that we focus on it is because we call it the engine of long-term investment returns. If you look at performance going back to 1926 of the S&P 500 and you looked at all the 5-year, 10-year, and 20-year rolling windows of time and average the impact that dividends have on return, even in the shortest period, the 5-year period that doesn't even allow for a lot of compounding, that's still 43% of returns on average for that long a period, almost 100 years. 10 years around 50%, and once you get to 20 years, it's dominant. So up over 60% of return is reinvested dividends. And so most people don't understand that, in part because it takes a long-term view and patience to accumulate those and compound those dividends. But it's very, very powerful over the long term. And it's also much more consistent to evaluate it that way than earnings. Dividends are always a positive impact on returns. They don't detract, where earnings and valuation adjustments can detract.
Okay, so thanks for sharing about the importance of compounding and the importance of having a long-term perspective. But the markets can be finicky and markets can be cyclical. So when does your strategy perform well and when does it not do well?
Yeah, that's a very good question, because our strategy, the characteristics that we seek are not rewarded in late bull markets. So basically, the end of this last decade, or in a period we just talked about with speculation and gamification, the things that we hold dear in our strategy and distinct competitive advantages, highly profitable, prudent gearing ratios, strong credit ratings, things of that nature aren't valued when there's a lot of speculation in the market. So our strategy would generally underperforms when the market is excited, exuberant, and particularly not when it's euphoric, where it actually got at some periods with all that stimulus. But where we do perform well is in markets that are in distress a bit, or in plodding markets through more difficult economic times. Because if you look at the 1970s, for instance, when we did have a lot of inflation, the S&P returned about 5.3% annually, so below trend that decade, and 73% of that return was attributable to dividends. So if you didn't have a dividend component, or you didn't reinvest dividends, returns were very difficult to come by. So we would expect to outperform in periods, again, of a bit more both economic and market distress. And one thing we try to do is hold on to more capital than the average investor in other strategies when times get rough. And if you look at the last the biggest 6 drawdowns in the S&P 500 over the last 12 years, and if you compare our strategy versus the S&P 500, the Russell 1000 value, and our dividend benchmark, which is the MSCI World High Dividend, so we were 18 comparisons, 6 periods, 3 comparisons each period. We outperformed in 17 of those 18 periods. I don't know if the record will be that good going forward, but we are structured to try to defend the portfolio more, and it's because we look at the risk components of how what we're investing in, hopefully do a lot of work on that prior to our investments, and that will show, and we'll be able to hopefully hold on to more capital than lots of other strategies.
So as we shift to your portfolio in general, what is the biggest risk you try to avoid in your strategy?
It kind of dovetails with the last thing we just discussed, permanent impairment of capital. The math of losses is so detrimental in portfolios. Obviously, a 50% loss in a stock requires a 100% gain to return back to even. And that's obviously just a math example, but the real world example would be someone that had the fear of missing out in the tech bubble back in 2000, let's say, and decided to throw a bunch of assets at the NASDAQ index fund near the top, let's say in March of 2000. That index, which was supposedly a diversified index, declined 78%. If you take a chunk of your portfolio that declines 78%, you need a 350% return to get back to even on that capital, which didn't happen on the NASDAQ for 15 years. So that is a permanent impairment of capital and is hugely detrimental to long-term success. So if we can hold our losses lower than that, a 10% loss requires an 11% gain to get back to even. And so that kind of thing is normal volatility. We just want to do our best to avoid the permanent impairment of the capital.
FOMO. So have you heard of JOMO?
No.
The joy of missing out.
Yeah. Yep. We have to take some joy in that sometimes, because obviously when markets are running and there's regret, let's say, in not purchasing certain things, that's a behavioral issue that we have to deal with, and we're all human, whether we run a defensive strategy or growth strategy or what have you. So we sometimes have to try to view it as joy. It's like, well, we didn't get that one and it is going up, but still looking at risk first is primary.
So part of your whole investment strategy is 3 tenets.
It is.
Can you share just those 3 tenets real quick?
Yeah, in our process, we focus on what we call quality, durability, and growth. On the quality front, it's some of those things we mentioned earlier. We look for distinct competitive advantages that we believe can be maintained for a long period of time. We call that competitive leadership duration. Because ultimately, we can't compound dividends if we don't have a competitive advantage that produces the cash flows to pay those dividends. So that's highly important. Quality would also be high return on equity, relatively low debt, strong credit ratings. We dovetail that with durability and growth, and that's of the income. And we want to see dividend cultures, companies that really are, they prize their minority shareholders by paying them a durable and then growing stream of income. And there's different ways that we look at that and try to define the culture of the company. But ultimately, we want to see very high quality companies that are dedicated to paying cash dividends, and not only paying them, but growing them through time.
So speaking of quality, durability, and growth, can you share some examples of long-term holdings in your portfolio?
Yeah, good question. So Johnson & Johnson would be an example of one we've owned the entire length of our firm, and actually owned it at firms prior to my own. So a very long period of holding. So J&J is a great company with distinct competitive advantages, so it fits what we just discussed there on the quality front. On the income front, it's paid an uninterrupted dividend since 1944 and grown, I believe, since 1962. In our time frame at Martin Capital Partners of owning it, they've grown the dividend since 2010 about 110%, which is about 6.5% per year. And so the yield on cost is quite attractive, and they've continued to do what we wanted them to do. Another would be Microsoft, which is a little different because it was more of a developing dividend culture. It wasn't already a distinct one like Johnson & Johnson, but they started to pay in 2004. They've grown it a bit every year since 2004. When we bought it in the fall of 2010, they had started to really develop a distinct culture. They have grown their dividend in that 12 years 377%. So they've distributed tons of cash flow to our clients. And because the stock's appreciated so much, the current yield is lower, and we have trimmed the position a bit, but it's one that's greatly benefited the portfolio and our clients in following that growth of dividends over the last dozen years.
So the joy of investing should be profitability and dividends and cash flow.
I agree with that.
So how about if we look at investment themes currently, how does Martin Capital integrate ESG or sustainability into your investment process?
So first, let's talk about sustainability. We always view through the lens of, is this enterprise building a sustainable business, and have they built that through time? Because we have a very long holding period relative to most strategies. We have currently, our average holding period is almost 5 years, where the average American investor, depending on the study you look at, is 3 to 6 months. And so we are not trying to trade to build profits. We're trying to own great companies to build profits. And the only way we can do that is if they don't cut corners in their business from all sorts of different angles. So we would call that sustainability. Nowadays, there's also, there's ESG and that sustainability and the lens that that people are taking from that angle, which there are a lot of different lenses on that front as well. What I would say to that is we have developed a strategy where we take the sustainability of our enterprises already and dovetail that with a firm that does ESG research. We utilize their scoring system to build a separate strategy that is even filtered more along the lens of ESG, and particularly in that portfolio, we eliminate some areas. So we exclude some areas that our main part of our strategy would own, and then we build a scoring system with them to then rank our current holdings on that front. So we have some kind of a direct strategy built around ESG, but it's still frankly high dividend payers, good dividend growers. So it's still within our QDG philosophy.
And for our clients, ESG represents
environmental, social, and governance issues. And again, those are a bunch of scoring and risk metrics. And the industry, it's growing so fast, and there's so many angles to view that ours has its particular bent, as most do. But basically scoring along all those categories.
And thoughts of customizing using a separately managed account for investing in a mutual fund.
So we only run money in separately managed accounts, and we do that because we feel that it's the most tax efficient way for clients to own those assets. Also, when there's real stress in the market, mutual funds have to deal with flows that, even if you're a patient investor and your neighbor isn't, can affect the fund flows of the collective fund that you may own, and can impact in real stressful situations the execution of their strategy. So we feel in separate account where the client owns the securities outright, we just have authority to trade for our strategy, is effective from an execution of our strategy, but also from a tax perspective, in that we can do things to offset gains with some losses, particularly towards the end of the year. Often we can do that, and we can make decisions, I think, that are a bit independent of a pooled collective fund.
Sure. And then as it relates to ESG, your clients, if you're going to build them an ESG portfolio, you have the ability to be more bespoke and customize a portfolio?
We do, but our customization is basically based on our history. So to go a little bit farther on that strategy, throughout the last 3 or 4 years that I've been managing an equity income strategy in Oregon, where we are, a lot of bent has been, I don't want any fossil fuels, or I want very little fossil fuels, no open pit mining companies, no weapons manufacturers, no tobacco. So what we did is we built a strategy that started by excluding those. And a lot of strategies don't, but that's where we did because of the bent of our clients originally. And then we score those now through the third-party firm that does research in this area after we've done our research and our work as well. So it's an add-on or a dovetail, if you will. So we can bespoke it, but we really have built something that is custom to the tendencies of our clients in the past, and so we've built it with that structure going forward.
Oh, that's great to hear. What is the most important investment lesson you have learned from all the years you've managed portfolios?
I think I'm going to be redundant here, but it's going to go back to preserving as much capital as you can, and you do that not during, although maybe some good traders can pair positions as they're cascading lower. The best thing in our view to do is prepare ahead of time. So the market is really infatuated with high beta story stocks. All the cocktail party talk, all of the media is centered around things like Amazon and Tesla and Netflix that have been massive winners over the last 15 years. But for every winner, there's hundreds of losers, and those losers were the high beta story stocks that didn't make it. And the problem is a lot of portfolios own those others. They may own the great ones, but if the losers provide super damage to those portfolios. So we try to eliminate a lot of those up front. We realize we're going to miss because our strategy would unfortunately have us miss the real growers like Amazon through the years and maybe Netflix. But it's also going to protect us from a lot of the other inferior performers, and so therefore we can hold on to more of our capital and compound that consistently through the years.
So just to shift gears, outside of work and family, what's your favorite activity?
I enjoy a round of golf with my buddies. That is enjoyable. And the other thing is a really good view, quiet, or maybe listening to some music. But the world moves fast, and I don't mind a good view and just hanging out, relaxing.
Okay. iPhone or Android?
iPhone.
And what is your favorite app to track the markets and the economy?
I'd have to say my default is the Wall Street Journal app. I've read the paper the longest. I've just kind of, it's been a default source for a long time. I actually trust them probably more than other sources. Might be Financial Times is close. I don't like it as much, but it does have a good global bent.
And what is your favorite app for personal use?
Well, it probably has to be my favorite by default again, because I'm a diabetic and I have a CGM in my arm, and so my app, Dexcom app, tells me where my blood sugars are. So from a health perspective, I would have to call that my favorite, even though it's not the most fun. Most fun would probably be one of my music apps, and I've always loved Shazam because I'd like to be somewhere. If I don't know a song, it's pretty cool to know it, the artist and the title pretty quick.
Alrighty, so last couple questions. You mentioned the Wall Street Journal and the Financial Times. Do you read the physical newspaper or digital?
I much prefer the physical.
Food section or entertainment section?
Well, food.
Live sports or binge watch TV show?
Sports.
Sneakers or dress shoes?
Prefer sneakers, but mainly wear dress shoes.
Morning workout, evening workout, don't work out?
Not disciplined enough, but I like to walk and play golf, and that's basically my exercise.
Thank you for your time today, Cameron.
Thanks, appreciate it, Jamin.
I hope you've enjoyed today's interview and gained some perspective and insights from Martin Capital Partners investment strategy. We look forward to sharing future Money Manager insights.